Every business should have access to high-speed internet, no matter where they are. But getting fast speeds in rural Canada hasn't always been easy, which meant less reliability and connectivity. But not any longer. ExploreNet Enterprise Solutions has the network to help you do business virtually anywhere in Canada. With our extensive fiber, fixed wireless, and next-generation satellites, we're bringing the high speeds of the big city to small towns, tiny towns, and no towns. ExploreNet Enterprise Solutions gives you the kind of high-speed internet your business can rely on, so you can stay productive and stay connected across single and multiple locations. Plus, with our 24/7 dedicated support centers and coast-to-coast dealer network, help is never far away, whether it's Dave in Portage La Prairie.
Hey, this is Dave.
Or Katie in Ontario.
Hi.
No matter your business size or location, get connected with ExploreNet Enterprise Solutions.
Morning, everyone. Bon matin à tous. Welcome to this morning's webinar presented by the Chamber of Commerce for Greater Moncton. My name is John Wishart, and I am CEO at the Chamber. We're very pleased today to have with us a great supporter of the Chamber, Jared Burns, the tax and estate planning lead at Louisburg Investments, who will talk about financial survival for entrepreneurs. And if there has ever been a period of time when financial survival is more top of mind, it's been in the last 2 years as we all battled our way through COVID. So really looking forward to Jared's expertise this morning. First, though, I'd like to start off by thanking ExploreNet Enterprise Solutions for being our sponsoring partner for this new series called Chamber College. So with that, I'd like to introduce Marie Martell, who's the marketing specialist with ExploreNet, to say a few words of welcome. Anne-Marie?
Hi, thank you, John. So welcome to today's presentation. We're ExploreNet Enterprise Solutions. We have nationwide coverage with fixed wireless, fiber internet, as well as satellite with over 400,000 subscribers. And we're very excited to be partnering with the Chamber of Commerce of Greater Moncton for the Chamber College series. So enjoy today's presentation. Thank you.
Thanks, Anne-Marie. I want to remind everyone that we will have a Q&A session at the end of Jared's presentation, and you can pose your question at any time by using either the chat or the Q&A button at the bottom of your Zoom screen. Just type your question there and we'll pose as many as we can as time allows. So a little bit more about Jared. Jared holds a bachelor's degree in commerce from Mount Allison University. He obtained his Chartered Accountant CA designation in 2012 and has completed the 3-part CPA in-depth taxation curriculum. He's completed level 1 of the Chartered Financial Analyst CFA program and finished the Canadian Securities Institute's Partners, Directors, and Senior Officers course. Jared's worked in tax advisory and planning services, focusing on owner-managers of businesses for several years at 2 multinational accounting firms before joining Louisburg in 2016. So at Louisburg Investments, Jared leads the tax and estate planning services section, where he works with their investment team, clients, and other professional providers to identify tax and estate planning opportunities custom to each client's unique circumstances and needs. So enough talk from me. With that, I will turn the virtual podium over to Jared Burns to lead today's discussion. Jared?
Great. Thanks, John. Just going to bring up the share screen here. Okay. You guys can see the presentation, I hope.
Yeah, all good, Jared.
Great. Okay, so definitely a pleasure for me to be here. I think the work, as we can all agree, that the Chamber does is quite incredible and very helpful for our business community and enables it to thrive. We're going to talk about small businesses and turning them into bigger businesses. And small businesses is a wide definition, and we'll see how wide that can be in a couple slides. Hopefully you guys all have a copy of the deck available to you and in front of you. There's going to be some parts we're going to cut out just for the sake of time. So I know it looks overwhelming, and how are we going to do this in an hour? We're just going to try our best to hit all the important points and definitely focus on being available to answer any questions that come up that may be on your mind or come up as the presentation goes. What I'd like to do quickly is to help establish sort of the audience and where they're at, which I can't quite do in person and just ask you face to face, but essentially, if you could open the chat function and in there, just put a capital Y and then a number. The number is going to be the amount of years you've been in business. So if you've been in business for 1 year or less, just Y and then 1. Y2 for 2 and less. If you're not an entrepreneur but thinking about it, just put Y and 0. I'd also like to see if you could put before you put that in there, a P and then the number of people you have in your business. And then a plus, equal, or minus sign if you are growing, plus sign. If you're steady in your growth, an equal sign. And if you're declining on your growth, a minus sign. So that's going to help me basically understand the audience. It'll alter the slides I focus on a little bit. And while you're doing that, I do have a quick blurb to go through. So bear with me. This is presented by Chartered Professional Accountants of Canada, CPA Canada. It's one of the largest accounting organizations in the world. There's 217,000 members across the country. As you probably heard in my background, we work in various different industries. Some work at accounting firms like myself for a while. Some work in entertainment, sports, technology. A lot of them are in not-for-profits and finance. So, you know, it's a wide breadth. It's a great skill set. And we're definitely a good resource for helping businesses grow and get to that next level. Again, if you do have questions, John already went through the Q&A and chat function, and just don't hesitate, because I think that's what the real value is. So let's start moving. And as those numbers come in, I can't see them on my slide, but John, if you just want to let me know sort of what kind of looks like the general consensus at any point, just cut me off.
Jared, maybe I can give you a bit of intel right off the bat.
Sure.
So far, years of experience range from 0 to 28. So okay. I would say the average is somewhere in the 5 to 10 year mark.
Yeah, perfect.
Most people are smaller in terms of size of employees. Yep. And the majority have either had equal or a plus sign for the last year.
Perfect. Okay, that's great. It'll help a lot, and you'll also see a stat that'll show why most people have smaller amounts of employees. So we're going to go through some key topics. You know, we're going to talk about managing your growth, the key numbers to understand and monitor. This is something that I find is overlooked a lot. Maybe just because it's intimidating for a lot of people to get into numbers and ratios and stuff like that, but they help make key decisions, and we're going to see some examples of that and why. We're going to quickly look at the statement of cash flows. It's, cash is king. A statement of cash flow is a bit of a complicated statement to put together, but we'll look at it regardless, because you may get one from your accounting firm as you grow, and you need to get more schedules for bank covenants and such. So we're going to talk about how to read some of the ratios that are key and understand how they can be used to project where you're heading. There's a group session, Scars of the Norse case study. I don't believe we're going to get to that in detail, but we'll quickly look at sort of what are the key takeaways of that. My favorite slide, and it could be, I guess, a presentation all on its own, is essentially effective tax strategies. So I'll try to do that as a high level as possible. There's a lot of points on that slide. I'll do high level, but again, questions, feel free to bring them up. That's one that I can definitely speak to with plenty of confidence and experience with. Financing for the big leagues. That one is pretty broad. So I'll focus on some of the key financing ones on that. But again, being at an investment management firm, fairly comfortable with some of the key metrics that banks look for, that investors look for, the trends, because we monitor that stuff on a day-to-day basis. It's earnings season right now, so a lot of Canadian companies are releasing their quarterly results, and you're going to see a lot of share prices moving as the market digests some of the trends that come out of that. So that's a key part of the financing. And then we're going to give you some tools and resources to help you essentially navigate some of the trickier parts of your business growing. The tools and resources, I'll probably add a couple of my own verbally, and then maybe we can send them out after the presentation. So yeah, as I said, small business is it's a pretty big group. I mean, you've got 1 to 99 employees as defined by Industry Canada. Medium business, 100 to 500, and then large business 500 or more. So of the 2.4 million businesses in Canada, about 80% of them are 4 employees or less, and that's 1.3 million being just no employees. So it's a big number. That's why I'm not surprised with John's statement that a lot of them are smaller groups or even sole proprietors. It's just the reality of the entrepreneurial world. So I find that actually quite interesting when I read that, but not terribly surprised. We're going to talk about bookkeeping. Very exciting, but it is key. So a real important thing to remember here is that bookkeeping can help you make decisions in a timely manner. So that's why I like the idea of monthly bookkeeping. You need accurate records to be able to make good decisions. Wait until the end of the year to get your statements, and then sort of deciphering them and then making your decisions then. Chances are you've either missed an opportunity or you've done something that cost you money. So bookkeeping it's relatively cheap if you're a small group, like the majority of the participants here today. You're going to want to get one, and it's not expensive. A lot of people think it is. A good bookkeeping service. For example, my sister has a exciting family. She's an accountant as well. She has a firm in Truro, and she charges $55 an hour for bookkeeping, and also trains the staff there so that eventually, if they would like to, they can take it over on their own on a part-time basis type thing. So it is worth its weight in gold. It doesn't have to be a big expense, and it will save you money, and it will help your growth, because every month you're going to be able to use some of the ratios we've talked about, see some trends, and not only that, but you're going to give to your accountant at the end of the year a package that's going to already basically be done. So you're going to save at the back end with your annual fees for doing your compilations, your review statements, and your tax returns and stuff like that, because your accountant doesn't have to charge you to basically reconcile the entire year. So keep that in mind when you're thinking of the cost of bookkeeping. It will have some savings that are immediately realizable, and then also will be realized as you go through. So revenue, sales, and gross profit. I don't think this is a surprise. Sales is the amount that's invoiced to customers or clients before tax. Gross profit is basically sales minus the cost of sales. So you want to know what your revenue is year to date. And again, bookkeeping is going to help you with that, especially if you're seasonal. And you want to know how well your revenue flows through to your bottom line. And the first kick at your bottom line is the cost of your goods. And it's a good measure to know what your percentage of the gross profit ratio is. Obviously, the higher the better. Leaves room for absorption of abnormal business periods like we've just endured for a very long time. And the higher the gross profit percentage is, the better you can perhaps absorb what's going on right now with record-breaking inflation, 6% year over year in Canada and climbing, 7% year over year in the US. So ideally, you try to pass that on to your customers as best as possible, but sometimes that's not an option. And you need to temporarily absorb some of that into your cost of goods. So like I said, you take your revenue less your cost of goods sold gives you gross profit. Take your gross profit and divide it by your revenue. That gives you your percentage. So pretty easy to do in the deck slide that you see. 100 less 36 is 64, and then 64 divided by 100 is 64%. So that's a very strong ratio. One of the things I definitely want to point out to is cost of goods depends on your business. So a lot of you are smaller businesses. So chances are your cost of goods are actually your time. So whether you charge by the hour, that might be, you build up what's called a WIP. So your work in progress turns into billable hours, and that's your cost of goods sold. So if you're, not on a factory, you don't have a factory and there's no factory line workers, then, you're going to want to know that the materials and the factory line worker are all attributable, costs of sales. Sometimes it's good to break those out. As entrepreneurs, you're gonna be wearing multiple hats. So you may be doing some administrative work and you may be doing some billable work. So you're going to want to try to get that division as clean and clear as possible so that you know exactly where your costs are coming from. Because if you just lump it in together, it makes it much more difficult to make decisions, especially about your billing rate. If you're noticing your cost per hour for you to do your work, so that's your wage that you'd like to take, or the wage of one of your associates that's billing, is creeping up to the same rate that you're billing out at, you may want to adjust your rate, especially with inflation. You're going to want to start charging more. And it also helps as people develop and get better at what they do, yourself included. That means you can get more done in an hour, so your rate should go up. And then as your rate goes up, that also means your cost of goods is going up, but you're maintaining that gross profit margin, which is very important. So when it comes to that, like think law firms, accounting firms, consulting, those are the people that you're going to hear talking about, like I said, WIP and billable hours that I say are part of the cost of goods sold, or you may have heard of it as an above the line expense, where administrative type expenses are going to be below. So we'll look at some of that here in the next slide. So on your expenses, it's good to group like expenses together, but don't group too much. If you group too much, then it's going to be sort of hard to really understand what it is that you're looking at and make decisions with. But don't break it out to every possible little minute detail, because there's a utility of a rate of return for how much you break it out and the time that it takes, and the amount it helps you make decisions. I mean, it reminds me of like when you do a home budget and you do groceries, you don't have to break out, the cost of berries, but I wouldn't lump into groceries, your meals that you go out for, and entertainment and stuff all into groceries, because then it's you're not going to notice that you're going out to eat too much. You're just going to think that you're buying too many groceries. So find that balance. It's very key. And yeah, like I said, it's a bit of a double-edged sword. Watch for trends. This is kind of what I really try to do when I see statements with clients and working with them is some of the trends. Trends are not just year over year, but inner year. And I'll give a good example in this particular scenario is you see a marketing expense there. And as you look your year over year marketing and it's going up, you should expect that, in the current year, or at least the following year, or, the following quarter, if you got good bookkeeping, that your sales are going to go up, because that's the point of marketing is, recognition. You want to be visible, and visibility usually leads to sales. So if your marketing is going up and your sales are not, then maybe you need to revisit your marketing strategy and take a different approach. And whether you do that internally or you hire someone, maybe if you're doing it internally, it's time to spend some money, a little additional money to do it professionally, or if it's done professionally, it maybe bring it up to them to see if they have any other ideas, or worst case, I guess, is switch to a new consultant firm. But that's an example of an expense that ties to other items in your income statement. So be wary of that. And then try to make sure that you're aware of the different expenses as far as accounting expenses and cash expenses. So we're going to start to look at that a little bit. Operating profit. So this is your earnings before interest and tax. It's used a little bit. I don't see it, as often as I see what we call EBITDA. So the one, one below. Earning before interest, taxes, depreciation, and amortization. I find EBITDA is just a little bit better to have that amortization number in there. And basically what you're doing there is you're carving out these notional numbers that represent the expense of large purchases, capital purchases, buildings, big equipment, and it's breaking that expense and it's spreading it out over multiple years. But it doesn't actually tie to cash that's gone out of your pocket. You've already spent that money. It may be tied to a loan you're repaying, but as far as the bottom line goes, taking out those non-cash items can help you really know where you are on a cash basis. And cash, as a lot of people have heard, I'm sure, is king, and it is the lifeblood of your business. So managing cash is a major goal of this presentation, is for you to learn that. And from EBITDA, we get into our bottom line. So net income before taxes, it's negative. Obviously, you have a loss. How long are you willing to have losses is a question. I mean, we were in a special situation not too long ago with COVID, so you're going to have to, realistically expect some losses during that time. But in a normal operating environment, you have a loss, 3-4 years in a row. Do you really want to keep doing that and having it accumulate, or is it time to, cut the cord and try something else, or realign your business some? So a lot of people, they like to keep operating a business that's losing, and they get into needless amounts of debt. So in finance, when we see people that want to hang on to stocks really long as they're declining down because they feel like they're going to rebound up, even though all the data suggests otherwise, we call that loss aversion. So that can happen with your own business even more, because that's your sweat equity, your time, and it's just difficult to let that go. So be wary of that inner bias that you're going to have about your business, and we talk about it some more as we go on, but it's critical to know that it's just not working out, and it's time to sort of move on, and your profit and loss statement is going to help you sort of determine that. But it also may show you where you're spending too much money, and you may be able to cut some costs, and then all of a sudden you don't have losses, you have some profits. If you do run with losses, and many of you may have with COVID, if you're incorporated, you can carry those losses, back 3 years, or you can carry them forward 20 years and apply them against income once you do become profitable. So if you were profitable, it's always a good idea to go back and apply those losses against that income and get some cash right away. If you don't want to go back and redo the returns with your accountant, you can just apply the losses if you know you're going to be profitable in the next year. But think of the time value of money there as well. So you can use those losses if you're a sole proprietor and you don't have a corporation, but you have other revenue. So say your business is sort of a part-time thing, and you have some losses because of COVID or just environment's changed, but you do make some money on as a salary person at a different job, you can apply those losses against that income. So that's why I always like to tell people that are starting businesses, don't necessarily have to incorporate right away, because you're probably going to have some losses getting your feet on the ground and running, and it's good to use those losses against your other income that you have personally. So that's always an important factor to consider. Statement of cash flow. So this one here is something that your accountant is going to help you with. It's a schedule that they can do if you want one. The bigger and faster that you're growing, the more important the statement is. And basically, if you're running a smaller, medium-sized business, you know the importance of cash. As you continue to grow and become larger and cash is moving faster and you're financing items more, you're going to want to see the ins and outs. And that's going to be important because it's going to help you with the timing for businesses that are seasonal and for businesses that are making big decisions on growing. So seasonal is definitely important. You think of businesses that have dead times, Magnetic Hill Zoo, MacArthur Nursery, is busier in the summer, golf courses, construction companies. So you all need cash flow statements, and very often with that cash flow statement will help you time, perhaps the need of a line of credit to float you through until you get to the money making months of your year. If you're using a line of credit during your money making months, then that's obviously a sign that there might be some issues with the business. Statement of financial position. There's a couple different schedules here that are important. Accounts receivable agent and accounts payable agent. So very often I see companies that don't appreciate the seriousness of collecting fast and making their payments quickly. So when I say that, I essentially mean if you have receivables, that's money that is not in your pocket to do, activities that will lead to growth. And the longer that those receivables stay in and age, the probability of you collecting those receivables goes down. And I know a lot of people think, well, I've been in business with them forever and they always pay eventually, even if it's 90 days. Well, that's 90 days without the money. And that's also a long time for the person you're wanting to collect from, for them to have something happen that makes them, unable to pay you. So the quicker you get it, the money, the quicker you're going to have that cash, the lower chances of not collecting. I think I think of the example of, you get sometimes someone to come and do some work around your house or, do some painting or help maybe build a deck or something. And it's not to harp on the construction industry. It's just a lot of times it's so busy in the construction year that you get your invoice 4 or 5 months later and you're like, oh, great, I forgot about that. And I'd like to think we all pay it, but I think the chances of everyone paying it kind of dwindles a little bit. And it's annoying for your customers too. So get your invoices out and then collect them quickly. Because anytime you let that 60 to 90 day slot, so we like to break down our agent schedule from first 30 days 30 to 60 days, 60 to 90, and then over 90. Really, you don't want anything over 90 sitting in that column. And you really want to keep that 60, 90 day low. And you really want to try to keep it under 60 days realistically. So, anything above 60 is, arguably could be deemed as bad debt by your accountant when you do the statements, and that doesn't look good for your bank and stuff like that. If you have clients that owe you money and it's been over 60 days and they want you to continue to do more work, don't do the work until you've collected on your old receivable. And that's a rule that's sometimes really hard to enforce because it might be your biggest client, but it's just not realistic for you to float that much cash and then continue to work to the point that that number gets really big and you start to worry. So always collect before you start a new engagement. Most of the time it's just asking, and they're like, "Oh, right, okay, let me reach out to payables and make sure they cut you that check." You just tell them, "I'd love to do the work. I'm really excited about it, but we have some debt to clear up, and if you could clear that up first, then I'll get started." The accounts payable agent schedule is very similar breakdown of time. It's how much you owe each supplier. A big thing is to avoid late payment charges. That's not a necessary expense. You don't want that. And not only are you charged for it, but you kind of fall out of favor with your suppliers and that reputation that you've tried to develop. So we think of right now, we have a supply chain issue for a lot of people. And you think of a business to business enterprise, and they're supplying you with, say, windshields, and you're always late to pay them for their windshields. Say you're speedy and for some reason you're late. And then, another spot is always paying them on time and fast, and they only have enough for one shipment. Chances are they're going to get the shipment and not you. So that reputation is important to pay your bills on time, and try to take advantage of the discounts. You'll probably see the terms like 2/10 or 2/20. That means basically if you pay in 10 days or 20 days, you get 2% off. So that's cash in your pocket. That helps. Plus, it puts you in favor with your suppliers, which we talked about. That can come in handy when your supplier has to make a decision between you and someone who's maybe not as good at paying their bills. So we did gross profit margin, operating profit margins, very similar. I'm just going to go over some of the key ratios. I don't look at operating profit margin as being, not that it doesn't matter. I just think gross profit and then some of the other ones are a little bit better, but it is there on the deck for you to kind of see how it works out and how you get your percentage as it is with the gross margin ratio. It's the higher the better. So that's important. We're going to talk about current ratio and the quick ratio in the next couple slides, and then some accounts receivable, turnover, inventory, and then debt to equity, and why these are important. So don't get intimidated by these ratios. They are quite easy to do, but keep in mind that they're only as good as the numbers that go in them. So that's, again, good bookkeeping is going to help you with calculating these ratios and making sure that you're able to make good decisions. The current ratio is what we call a liquidity ratio. Pardon my throat there, sore throat. And it's a company's ability to pay its debt on a short-term obligation. Current generally means within 1 year. When reading financial statements, you'll see a current section and long-term. So you take your current assets, you put them over top your current liabilities, and you hope that you get a number that's higher than 1, which means you have more assets and liabilities, and that means you're able to pay all of your current expenses with your own cash. If that number is less than 1, chances are you're gonna have to reach out and get a line of credit or dip into your line of credit that you already have. Most businesses establish one of those it's a good idea to have a line of credit, whether you're using it or not. Just don't get carried away with it, obviously, if you can avoid it. Sorry. Perhaps an even better ratio for telling you what you have for cash and liquidity is the quick ratio. And all the quick ratio is the exact same ratio as the current. So current assets over current liabilities. But you're taking out some of the items that are what we call illiquid. So they're difficult to turn into cash quickly. And that shows your inventory and prepaid. So this metric is a key metric for banks as it measures your solvency. So if you want to go in and get additional financing and your quick ratio is low, below 1, there's a good chance they're not going to finance you or give you the loan that you want. So getting that number nice and high is a good thing. Something around 1.2, 1.3 is a nice ratio. 1.1 is even okay. So accounts receivable turnover, and we also, I have some notes here to go over with you of inventory turnover, but I might skip the inventory turnover just because of the sample size or the sampling that John gave me as far as information, because I think most of you are probably more concerned with accounts receivable, but the concept is the same in both scenarios. So essentially you're taking your turnover, so your net credit sales, and basically dividing them by your average accounts receivable. So take your opening accounts receivable plus your ending AR accounts receivable and divide by 2, gives you your average. Not too difficult there. And then do out the arithmetic to get your ratio. And here we see it's 10. So the average is 20,000. 200,000 is your net credit sales. And then you take that 10, and you invert it and divide 365 by the turnover number. And the higher, the better. Higher means essentially that you have less money tied up in your AR schedule, and it means you're collecting your money faster. So that's good. And it's the same idea with inventory. So, beginning inventory and an inventory divided by 2 is your average inventory. And you basically use that cost of goods sold, divide that by your average inventory. That gives you your turnover ratio. And then you take that ratio, put it underneath 365 divided by the turnover. And again, higher is better. It means you got less money tied up in your inventory because it's not sitting on your shelf, but it's in your client's household, or they bought it from you. So, good ratios to keep an eye on. Debt to equity. This is one that we see as you get bigger. It becomes quite important. And it's also something that the bank likes to use a lot of as well. So it's essentially a very simple calculation, but again, the quality of the numbers are going to help you with the quality of the ratio and the decisions you make with it. So total liabilities, and then your owner's equity. And it's always going to be point something, just because of the formula of basically assets plus liabilities. Assets equals liabilities plus equity. So it's never going to be more than 1, but it does show you how leveraged the company is. So how much debt it has, and in comparison to the equity that it's built. Equity is often what you find in your retained earnings and your share capital. For most entrepreneurs, share capital is nominal. You pay $10 when you start the business to the lawyer when you're incorporating, and create your share capital. And then your retained earnings is your main component of your equity. And the more you can grow that retained earnings, the better that equity portion is going to look. And then use that to calculate how leveraged your company is. And that is basically the extent which debt is used to finance the business versus the retained earnings. And one thing I like to point out, because it's a term that's used a lot in finance, and it's leverage isn't always bad. I'd like to think of the word leverage in its literal sense. It allows you to lift heavier items. So in this case, higher leverage might mean higher or more of a return because you've been able to apply more capital into your business than you would have otherwise been able to with no leverage. So it is good to have some leverage, some debt. So there's good debt. So we want to make sure that we do that. We do that well. We're going to skip the activity for the matching game. There's a sheet that you probably came up with, but in case you do want to do it, we can give you the answer key. Just email John or myself, or we can get it at the end of the presentation. But just for time's sake, we're going to move on from that. Right. We're also going to skip through the case study. We don't quite have enough time, but what I'd like you to take away from it is essentially watch for trends. Trends tend to be what's used as indicators for what course you're on, how you're going to do in the future. We've seen it with stock markets. It was last week or the week before. Netflix growth was still growing, but it grew at a slower rate as far as subscriptions, and that stock dropped 30% and change. So trends are critical. I'm not saying that your business is going to be 30% worth less if you have an off year, but it's important to look for trends, and trends not just year over year, but trends within your statements and your information. Like we said, with the marketing expense. So if marketing expenses is going up, well, hopefully sales are going up, and if cost of goods are going up, then hopefully you're able to pass that on to your consumer and increase your revenue. So it's a good idea to know, the trend. So use that case study just sort of to do that. So here's some of the numbers that it shows, what sort of happened in the case study. So use that for yourself. Effective tax strategies. So we're definitely coming close on time here, and this, like I said, is my favorite slide. So I don't want to go over it too quickly because I think it's arguably one of the most important slides. But right now in New Brunswick, the combined small business rate is 15.5%, and that's a low rate. The federal government's pushed to have it low. The federal rate's 9%. New Brunswick's is 2.5%, and that's on a maxable annual earnings of 500,000 or less, assuming that you don't have any associated companies with it, because an associated group has to share the small business deduction limit. Otherwise, people would just create new companies to get more of those $500,000 deductions. So that's why that rule is there. And may or may not be familiar, there was some big tax changes in 2017 that basically created a grind to the small business deduction limit if you hold passive assets in your operating company. So or in any corporate form that's tied with the associated group. So if you earn more than $50,000 in passive income from, say, investments that you left in corporately, every dollar that you earn above that is going to cost you $5 in your deduction limit. So eventually that can go all the way down to zero. So these rates are obviously they're lower than what you would pay personally when you pay a personal tax, but the money is locked in the corporation, and you will have to pay the tax when you take it out. The lower rate really is it's an incentive to keep money locked in the company so that you reinvest for growth, expansion, hiring, and that way there the idea is the economy grows and the tax base grows for the government, and that's why they use this small business deduction regime. It has its advantages too, in the sense that if you are incorporated, you can time your salaries out if you don't need that much money. You don't have to take the tax on all of it that you've earned in the business. You just take out what you need via salary or dividend, which we'll talk about in just right now. So basically, you have two different ways to get your money out of a corporation if you are incorporated, and that's salary or dividend. And the two sort of reasons that you may pay salary, both are meant to equal the same. So the concept of integration is, the system is worked so that you should be indifferent tax-wise if you do the dividend, or if you take the deduction for paying the salary and then get taxed personally on income. But what you do need to consider for salary is it does create pensionable earnings. So, it goes towards your CPP plan. As an owner, you probably know that you have to pay this twice, once for yourself as a salaried person and then once as the employer. Someone like myself who just gets a T4 from Lewisburg is paying that other half for me, and I pay my half. So be wary that it will be it'll be double. So $6,333, 30 some dollars right now. And the other thing that salary does do, which is nice, is it creates RRSP room, and dividends do not. So if you're making good money and you want to lower your taxes personally, well, an RSP is a powerful investment tool. And if you're in it for the long haul, investment wise, investing in a RSP and taking the tax hit early and letting it grow tax free will outperform generally invested in your corporation on about an 8 to 9 year period or time frame. Management fees, I don't know if a lot of people do management fees. It's something usually you see for intercompany. You charge a company a management fee or whatnot. Maybe you charge the management fee, but just remember it has to be for specific services that you've performed. It can't just be an arbitrary number that you use because you had a good year and you want to move some money into a different business so that the optics are better. So it's not based on results, it's specific, and it has to be sort of predictable, and whether it's formula based, whether it's service based, and it also has to be a legal obligation to pay it. So you're going to want to have a draft contract done up. So that's the key facts for the management fees. Income splitting, for salary, you can pay family, if they're working at the business, a reasonable salary, and the key word there is reasonable for the duties that they're doing. So think of what you would pay, a regular person who's not family to do that job, and that's what you pay, a spouse or a child. And they actually have to do the work. I've heard stories where CRA will test this, and they'll want to require that they prove that the spouse works at the business, and they say, yeah, this is her desk, this is where she does her stuff, and the CRA didn't ask that person to log on at the computer, and that person didn't know the password. So obviously that's not going to look good. So don't just put people on there and pay them a salary. They have to do the work. So, and that stuff gets tested quite often. And if they are doing a salary, set them up proper, get them business cards, they have their phone, the tools to do their job, and keep timesheets. So when CRA does come asking, you're ready. Dividends to family. So this paying out of dividends drastically changed again with the same set of rules that were put out in 2017. It's much more difficult to income split using dividends. You can get $35,000 to $45,000 tax-free in a dividend, essentially. So CRA and the Department of Finance found that abusive. People often used it to fund their children's education. But right now, it's a complicated set of rules if you want to use dividends to pay out. But a general one that gets you the ability to get dividends is if you are actively involved in the business and you work, over 20 hours a week, and you've been doing that for at least 5 years, then you're entitled to dividends as a shareholder. If you're not supposed to get those dividends and you pay them, they'll be taxed at the maximum rate at the very first dollar. So really want to avoid that. And yeah, the next one here, we have sort of the Firmware Bonus. I'm not going to talk about that. It's just basically, if you do a bonus route, you get 180 days to actually pay it. So there's a cash flow draw, and then some other considerations that are important. Be careful with employee versus contractor. So if, you got to think of who bears the risk and who controls the arrangement. So if you're bringing someone on and you're like, oh, I don't want to pay him CPP or EI, I'd like them to be a contractor, but you require them to be there and working for you Monday to Friday, 9 to 5. They use your computer. If work doesn't get done, they don't get paid. You're bearing all the risks. That's an employee. And a lot of people and companies at West for a while were trying to push their the employee arrangements into contractors, and they got slapped with penalties and fines, and they also basically had to repay all of the CPP and EI that they did not remit, because the person should have been considered an employee. If you're working and you pick your own hours and you get to decide what you do and don't do, and you bear the risk of making money at the end of the day or not, then you're a contractor. So there's some there's some information on Canada.ca's CRA website about how to determine that. So that's important. And the last one I'll quickly do is just paying your remittance on time. Always pay them. If you grow to the point that you have a board of directors, this is critical, because one day it's really the only liability of a member of a board is the HST remittance. So you're going to want to have a good record of that, especially for so we have CRA has a lot of training for new businesses, and that's really good. So asking yourself if you're ready to move on, it's that's a tough question to do, but numbers help. Numbers and ratios and patterns and trends are going to help you know if it's time to to grow and expand. And don't just use numbers. So go, use your gut, your intuition, what the business is as good as anybody. I always remember the story of the Irvins can basically look at any item on their their financial statements and tell you if it's right or wrong, and they're telling the accountant basically, just because they know the ins and outs of their business so well. And obviously that's a very successful business. So make sure if you're ready for it, but also don't sit sit on it for too long and be overly ready for too long, because if you're too busy, your service is going to suffer and it's going to get slower and you're going to start leaking clients. So make that decision when you're starting to bust at the seams, but you don't want to be busting at the seams for too long. So it's important. So make sure you have that in mind as you grow, and make sure as you're growing, you bring in the right people. The saying, hire slow, fire fast kind of thing. So that's going to be really important. Bookkeeping is going to become more important as you expand, and use your resources around you to decide if you want to lease or purchase, new buildings and stuff like that. And make sure that your expansion is contributing not just to the top line, but to the bottom line as well. If you're going to take on all this extra risk and time, you really want to make sure that it's going to come through on your bottom line, and be realistic about that. You always think of your home. Well, your bank thinks it's worth 20% less than what you think it's worth, and then a real estate agent is usually somewhere in the middle. So try to be the real estate agent of your own business, and that's a realistic sense of what the expansion will mean for you, and be ready to be able to show how that financing would work. So you're going to have a nice, strong proposal. Think Shark Tank, have the numbers, detailed planning and research has to be there for your bank to give you the money to go further with it, or investors. and know how much money is going to be required, know how much you think it's going to grow your business. Try to get as much borrowing as you can, because things are always more than you thought they were. So I always say, get your financing and then add tax, just as a saying. And make sure, like I said, that your projections are detailed, and you may have to ask for some terms that are not as favorable if your projections aren't great. You will probably always have to put up collateral. You may need a co-sign, like a parent or a friend or something like that. And another item I always like to remind people of, and I think I'll leave it, but this is, don't forget about the New Brunswick Small Business Investor Tax Credit. It's a great program. Look it up on Service New Brunswick's online. Look at the FAQs for that. It's just a good way to save some tax personally, to inject some money into your business if you need to grow, or you're hiring people, or you need a piece of equipment. So look at that for sure. That kind of leads to the tools and resources. They're there on your deck. They're all great. I like all of them. Ones that I would add, they were definitely really critical in COVID, but videotax.com has a lot of nice information for high-level tax stuff. Same with taxtips.ca and taxtemplates.ca. So you can tell that it's a very tax-heavy addition to the resources, but I think it's important. And like I said, the New Brunswick Small Business Investor Tax Credit is important. So make sure you go to gnb.ca for that one. So we're at questions. I really appreciate your time. I know it was a lot of numbers, a little fast. I can't imagine how we were going to get the case study done within the allocated hour, but hopefully you're able to look at it and sort of practice a little bit with those numbers and trends. So I'll open it up to questions. I think, John, you've been tracking them, have you? Or?
Yes, thanks, Jared, and certainly appreciate the detail of the presentation. I'm not sure we have shared the deck yet, but we will with everyone who registered, so you can look back at it. And because of time, we may just ask anybody who is online to send their questions through us, and we can pass them on to you, Jared. I do have one overall question that popped into my head as you were talking, and that's about budgeting and financial forecasting in uncertain times. And certainly the last 2 years have been the embodiment of that. And now we're into surging inflation and interest rate hikes. Any tips or tricks about how to carefully budget so that you don't over stretch what expectations? How do you manage that?
Well, that's a really good question, and it's I talk about it at home a lot with John, as you know, with Courtney, the CFO at the airport. And you can imagine losing 90% of your revenue for 2 years and having to do budget. The best way to manage it, I find, in uncertain times is to do a few different things. One is do it often. So rebudget, because it's volatile times and things are changing. So go back to your budget. You can't have a stale budget during COVID or during, record inflation and rising interest rates, that they just bumped, another 50 basis points. So adjust your budget for that. Another thing about that I like to see people do with budgets in uncertain times is do a worst case, best case, and likely scenario. So, and be realistic about that too. So do 3 of them in a line, and Excel's great for that. Time value your budget a bit, and use an interest rate that's that you can play with. To bring back the budget in, if you have the skill to do the time value on it, it's not too difficult. You just divide by the interest rate or the cost of money or the rate of return you're looking for, and then for 2 years you square it, and 3 years you put a little 3 up there, and 4 years and 5 and so on. But it's good to do it often. The bookkeeper is going to help so much on a time like that with with COVID and stuff like that. And it's going to help you with your line of credit and managing it and your shareholder draws and stuff like that. So same as a house budget, try to do a forecasting budget. I call it a roll-in budget. So try to be 2-3 months ahead with your budget. Don't just budget for a full year and then be like, okay, let's see if we can hit these numbers. Have a roll-in budget that's active, that basically just goes through the dates, and you know in 3 months if you're going to be in the red or not based on the budgeted numbers that you put in there. Because you're going to have some expenses that are fixed and they're always going to be fixed. And then you have some variable ones that are going to be tied to revenue, and that's where the worst case, best case, and most likely comes into play for those variable items to try to pin. But it's difficult to budget in times like this. It's almost where I'd almost argue that you want to use it, you want to keep going to it, and you want to make sure you have a good one, and it's discussed with the team that you have around you or your accountants or your network. But at the same time, it's a crazy time like COVID. I'm not sure how much value it may or may not add for those times, but for difficult times that are, that you got to work through, it's really important. So that scale can tip really quickly. So I don't want to say, here's how important it is to do budgets when times get tough, because it is very important. But when times are, as you just have zero sales, well, I don't know if it makes sense to do a big budget other than try to manage your expenses and see how it is that you're going to cover and pay, and know what it is that it'll help you know what it is that you're looking for government help, for COA loans and for financing and stuff like that, or Farm Credit Canada if you're in agriculture, stuff like that. So it is difficult. I'd almost suggest, obviously it's going to sound salesy, but to use a professional to help you with it. It's not expensive to help them run you through a budget, and or maybe you prepare it and they look at it and they ask you some questions, and it makes you readjust and think about it some more, because they've probably seen dozens of budgets, and a lot of them similar to your business, and they'll have some insight that's very valuable. So use your resources, and like I said, accountants are great for that.
Thanks, Jared. Here at the Chamber, we adopted that 3-scenario forecasting tool in mid-2020, best case, worst case, and likely case. And it really was valuable in helping to guide us through the rest of that year. And I also will reinforce your note about the value of bookkeepers and accountants. We employ both on a contract basis here, and they have more than proven their value through COVID in providing some good guidance. So
I do, John, if you do want to share with the people like my contact information,
yes, yeah.
I'm okay to take questions direct. Doesn't bother me whatsoever.
Okay. What we'll do is we'll send out the deck with your personal coordinates, Jared, and they can contact you directly.
That's great.
So with that, I'm afraid we're past time. I'd like to thank Jared again for his expertise. It's not easy content to digest, but it's important content, especially for business owners and managers. I also want to thank Anne-Marie from ExploreNet for their continued support of this series. Just a quick note that we'll continue to have Chamber College events throughout 2022. So stay tuned. We actually just quietly and softly introduced a new website this week. So check that out, ccgm.ca, and it has all of our future events there, including our AGM and luncheon with Premier Higgs next Monday. It's sold out, but there is a waiting list. We also have our Top 20 Under 40 Gala on May 26th, and our annual CCGM Golf Tournament on August 24th, which just so happens to be presented by Louisburg Investments. So thanks, Jared. We hope to see you that day. I think I saw you're already registered.
Yeah, I'll be there.
Perfect. Okay. So again, thanks everyone for attending today. Merci encore d'avoir participé aujourd'hui. Bonne journée. Have a great and a safe day and week. Thanks again.
Thank you, guys. Take care, everybody.